everyone, it is your investing coach Wahida here. Thanks for joining. I was able to save $100,000 at the age of 28, and now I teach other women how to build their wealth as well. So I want to talk about a question I get asked often, and it's, I'm ready to invest, I want to invest, where can I start? And I'm so excited when I get this question. I love talking about investing, obviously, but I love it when we get new people in and they're excited as well. And so I love this question. Okay, one way that we really can just dive into investing is if you have a 401k and you have access to a 401k employer match. If you don't have access to this, no worries. There's other ways that we can get invested, but this, if you do have access to it, this is, I want you to make this your number one important thing to think about, is making sure you hit the employer match. So a 401k is your employer sponsored retirement plan. And if you have access to a 401k, a lot of times employers will also give an employer match. So essentially, employers will say, if you put in, for example, 5% of your income into your 401k, we will match you at, for example, maybe 5% as well. So essentially, there's money on the table for you if you have access to this benefit. It's your money. Don't leave it on the table. So do what you can to make sure you're hitting this match. Maybe you're cutting back on some expenses at home. Maybe you're not going out to eat as often. Maybe you're taking more hours at work if you're hourly. Do what you can to make sure you're hitting this match, because this is essentially practically the only place where you can get 100% return on your money instantly. So essentially, you put in 5% and then your employers put in 5%, and then it's a 100% return on your investment, right? So make sure you're doing what you can to get this match. And I don't want to go into this too much, but why we have to first put in money before we get a match angers me, but whatever. This is where we're at right now. So beyond putting money into a 401k and buying investments through there, I want you to have a strong financial foundation. So this is looking at things before we are ready to invest in other areas. So number one in your financial foundation, so we've got two things to think about. Number one is your emergency fund. So an emergency fund is what it sounds like. It's for emergencies. This is a matter of when it will happen, not if it will happen. So because you never know if you will have an unexpected medical bill, or you have an unexpected vet bill, or you lose your phone, or you break your phone, or maybe you're driving cross country with your partner and a deer runs into the side of your van and totals it. Because that's what happened to us about 16 months ago. So that was not very fun. But because we had money in our emergency fund, we weren't stranded. We were able to take care of what we needed to take care of, so we were able to finish that journey, right? That move. Okay, so you want to make sure you have an emergency fund, because this is a matter of when it will happen, not if it will happen. So a fully funded emergency fund is 3 to 6 months of your living expenses. So you really can think of this as your bare bones living expenses. So if you lost your job today, what would you need to make sure your expenses are still paid for? So these are things like rent. We still need a place to live. So these are things like a car payment, like we still need to get to work. groceries. So we still need to eat, right? So think about what are the expenses you would still need to make sure you're able to survive without an income, right? So if you need some help like thinking through this, if you look at your bank statements, right? So if you pay with a credit card, look at your credit card statements, look at what you're spending on every month, so you have a better idea of what are the things that you need to survive. And then once you have that number, once you have that your bare bones expenses per month, multiply that by 3 to 6 months, and that will be your fully funded emergency fund. If you are more of like a freelance worker or if you have more irregular income, maybe you want an emergency fund closer to 9 to 12 months, right? So it really depends on what you're comfortable with. And so this can be quite a bit, so right, it can be thousands of dollars, so it's a lot of money. So don't be discouraged if you are like, I don't have that money right now. Just start putting a little bit away towards your emergency fund. It will start building. And if you're thinking, maybe I'll invest my emergency fund, we're not going to do that. We're going to put this money into a high yield savings account. This is the high yield savings account will give you a little bit back in interest, so you make a little bit of money off of it, but we're not trying to get rich off this money, right? We need this money for an emergency, and we need it to be accessible when we need it. So that's why we're going to put it in a high yield savings account, because when we need it, we have access to it very quickly. And it's not going to lose value, right? And then also, don't make your credit card your emergency plan. And that's one way to quickly spiral into debt that's very hard to get out of. Because if we're putting expenses on a credit card where we can't afford it already, where we don't have the money for it already, then we're essentially not able to pay that credit card back, right? And we're going to spiral into a debt spiral. So we don't want to get there. And talking about credit cards, the next thing that I want you to look at before you're ready to invest is, I want you to tackle high interest debt. So if you have debt with interest more than 11%, you want to focus on paying this debt off. And that's because this debt is costing you more money than what you would be able to make in the stock market on average. So high interest debt, these can be like personal loans, or like credit card debt is a big one. And so you want to make sure that if you have high interest debt, so interest rates larger than like 11%, you want to tackle this before you start investing. And in general, really, we want to avoid high interest debts, especially credit cards, because these are wildly expensive. Credit card interest rates can go up to like 30-35%, and honestly, that should be illegal. I don't know why that's around. Well, it's around because it's very lucrative for the credit card companies, but it should not be allowed to be around, right? So if you can get rid of your high interest debt, that's going to be a huge money saver for you. Okay, and that's the end of this video. Once you have an emergency fund, fully funded emergency fund, and you have your high interest debt paid off, and you're meeting your 401k employer match if you have access to that, then we can start looking at where else can we put our money to start investing. All right, well, thank you everyone. Thanks for joining me today, and come back every Monday. We will have new videos for you, and I hope you enjoyed this. Thank you.